Right now, fewer homes are selling in the United States than at any point since 1995. And yet, home prices are sitting near all-time highs. This chart shows the collision. Transaction volume dropped to mid-90s levels, while the median price climbed to a record $418,000. Normally, low demand causes prices to drop, basic supply and demand. But today, those forces stopped canceling each other out. If you are trying to buy your first house, you already feel this disconnect. The average first-time buyer is now 40 years old. If you're younger than that in renting, it feels like the system is working against your basic expectations of adulthood. In 2019, the national median home price was $272,000. Today, it is $418,000. That is a 46% jump in just 5 years. The penalty hits twice. You pay more for the house and the money itself. On a $320,000 mortgage at 2.65%, your payment was $1,293. Today's 6.5% rate pushes it over $2,000. That's a $730 monthly penalty for the exact same house. The situation is the predictable result of 5 years of overlapping shocks and specific policy decisions. Understanding that sequence is the only way to make your next move with your eyes open. In 2020, the Federal Reserve slashed rates to basically zero and started injecting billions of dollars into the financial system every month to stave off economic collapse. By January 2021, the 30-year fixed mortgage hit a record low of 2.65%. Buyers who had been sitting on the fence suddenly realized they could afford significantly more house for the exact same monthly payment. Then, the pandemic shifted what Americans needed from their homes. A 700-square-foot apartment feels fine when it's just a place to sleep, but it feels claustrophobic when it has to be your office, your gym, and your primary human contact. Remote work adoption exploded from under 6% to over 18% almost overnight. Millions of people suddenly had the freedom to live anywhere. Hundreds of thousands of households abandoned high-cost hubs like Manhattan and Los Angeles, descending on Tier 2 markets like Austin, Boise, and Nashville. These cities already had tight inventory. The stampede of buyers triggered a 37% national price jump in just 2 years. In migration hotspots, prices climbed over 50%. Those who bought in 2020 or 2021 secured one of the best financial outcomes of their lives, largely because they happened to be in a position to buy when the supply of national inventory was being entirely depleted. To fight the resulting inflation, the Fed executed 11 hikes in 16 months, the fastest rate tightening cycle in 4 decades. Mortgage rates followed, skyrocketing from 3.22% in early 2022 to nearly 8% by the fall of 2023. Right now, 51% of U.S. mortgages carry a rate below 4%, and 20% are locked below 3%. Selling means surrendering the cheapest money you'll ever access. The penalty of trading your old mortgage for a new one averages $65,000. This lock-in effect forces rational homeowners to stay in houses they've outgrown, suppressing an estimated 1.7 million transactions that would otherwise have happened, keeping active inventory well below 2019 levels. This chart maps the current reality for new buyers. To afford the median home today, you need to earn $110,000. The median household income is $83,700. The average American family is $22,000 short of qualifying. This jammed door dynamic has effectively halted the market, punishing new buyers with high entry costs while trapping existing owners with historically cheap debt. Many sidelined buyers are holding out hope for a 2008-style crash to restore affordability. The 2008 crisis happened because banks lent money to people who couldn't repay it, using subprime liar loans and zero margins for error. Today, the system is the inverse. Subprime lending is near record lows, and the median credit score for a new mortgage is 758, 50 points higher than it was in 2006. In 2009, 26% of properties were underwater, triggering mass defaults. Today, just 2.2% are underwater, and foreclosures are at record lows. Homeowners have $36 trillion in equity. Without negative equity, mass forced sales are unlikely. A sudden drop in mortgage rates could actually make things worse. Millions of buyers are waiting on the sidelines. A quick rate drop would unleash a flood of demand onto insufficient supply, causing prices to spike again. Today's market is financially sound but structurally constrained. Without a dramatic crash to rescue buyers, we are facing a slow, multi-year sideways correction where time has to do what policy can't. Let's look at a realistic buyer. Maya is 31, earns $74,000, has a 760 credit score, and saved $31,000 through 3 years of genuine sacrifice. Buying the median $385,000 home in her city would consume 65% of her take-home pay. After taxes, maintenance, and insurance, Maya would be left with roughly $1,600 a month for everything else in her life. This math has forced a hard pivot on life milestones. 84% of Gen Z aspiring homeowners are now delaying major life events, with 29% specifically postponing having children because their income falls $22,000 short of the market's entry price. The root cause of this pressure is a 15-year stretch of severe underbuilding that followed the 2008 financial crisis. This chart reveals the missing inventory. The historical baseline for new housing is 1.5 million starts a year. Builders pulled back for a decade, leaving the country short 4 million homes. Production of the entry-level starter home, under 1,400 square feet, has dropped 80% since the 1970s. The traditional first step on the wealth building ladder was essentially discontinued. The expectation of middle-class homeownership in your 20s has disconnected from mathematical reality, pushing that milestone deep into middle age for an entire generation. The real estate industry has a structural incentive to tell you now is a great time to buy. You have to ignore that narrative and make decisions based solely on your personal spreadsheet. This flowchart provides the only safe baseline. If total housing costs land below 30% of your gross income and you plan to stay at least 7 years, buying makes sense. Stretching to 45% of your income because of societal pressure creates a long-term financial trap. If the math fails at today's prices, the responsible move is to walk away from the purchase. One viable alternative is renting and aggressively investing the difference in an index fund. In a high-rate, high-price environment, the liquidity and compounding growth of an index fund can mathematically outperform the equity performance of an overpriced home. Another option is looking seriously at new construction. Builders are using rate buy-downs to offer mortgages at 4.5 to 5%. As long as the base price isn't artificially inflated, these incentives can make monthly payments competitive with existing homes for the first time in years. Navigating this market requires accepting that the era of blind appreciation is over. Ignore the market narrative, accept the structural reality, and only sign a contract when the real numbers work for you.